Well, the day of trading started off with a little bit of a touch and go type of feel to it. We did see a lot of the retailers here in the United States take the brunt of the selling first thing in the morning, as we heard from Macy's and JW Nordstrom's and L Brands and a few others regarding their sales over the holiday season coming in a bit light. So a lot of those stocks were down. But as the day went on, we did hear some more positive tones from President Trump regarding the negotiations in China supposedly going well. We also found out from Fed Chair Jerome Powell that he views the economy as being strong, but not so strong that he feels the need to rush into a whole bunch of extra interest rate hikes. He feels like he can be a little bit more patient. So all things said and done, that resulted in a fifth straight day of gains for the U.S. markets. Today in our trade application example, we're going to focus on a once hot tech stock that really stumbled late last year, but it's starting to get its mojo back. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 10th, 2019. First of all, if you are new to these videos, welcome. When you're on the YouTube site, make sure you subscribe to our channel, and while you're there, go to our description area where you can sign up for our email distribution list, which entitles you to all the stocks giving you overbought and oversold cluster signals in the S&P 500. Haven't seen a whole lot of overbought signals here recently, but lots of oversold ones, so make sure you're checking that out. Also, we are on Twitter. My handle is @BrandonVanZ. Make sure you're following me there, and if you get value out of these daily Market Outlook videos, be sure to click like and retweet on Twitter to let us know. In addition to that, we're on Facebook. Check out our group at the web address embedded in the logo in front of you. All right, let's go ahead and dive into the markets now. As you can see, I've got chart 4B pulled up in front of us. This chart will show us the four major U.S. equity indices here in the United States. And those of you that are premium market scholars are welcome to follow along with me with our charting package that we deliver to you with all of these various charts right here. So this one, again, is just chart 4B. And it's the 3-month version of the market forecast technical indicator view where we're looking at it on a 4-grid basis. Now, the way that we've got this coded up here is the color of the background of each of these charts will signify whether we have a bullish posture or a bearish posture. Now, beyond that, we can look at a slightly different nuance. So let me explain. Down below here, notice on the NASDAQ chart, which is the one in the lower left-hand corner, we now have a slightly deeper shade of green in the background color. Same thing can be said over here for the Russell 2000. What that means is that we now would perceive that to have a strongly bullish intermediate posture. And when I say me, I really mean the market forecast indicator, right? Every technical indicator has its own kind of rule set around it. So when we have a green line on the market forecast, like we do down here on the Russell 2000, going up between 20 and 80, we view that to be a bullish posture using that intermediate time period. But when it's below 50, we kind of are a little bit more cautious around it, understanding that, you know, any sort of news announcement in the stock market could alter the course of that technical analysis. And when it's below 50, it has the chance to push it into a strongly bearish posture much easier because it would really only need that green line to go then down below 20. Well, once we've coasted past the 50 level like we have right now, notice right here it says 53.23 and rising on the Russell 2000 and 53.25 and rising on the NASDAQ. So at that point, then we start changing to what would be perceived as a strongly bullish posture using that intermediate term line on the market forecast. Up above here with the S&P 500 and the Dow Jones, notice that we still have that lighter green shading, meaning that yes, we do have a posture, a bullish posture, but it is considered weakly bullish, not strongly bullish. And the reason for that is we're not quite past the 50 mark yet on that particular technical indicator. Notice on the Dow Jones, it's at 47.19 and rising. So again, not quite to 50. And the same thing here with the S&P 500 at 48.71 and rising. So a couple more up days, and I have no doubt that perhaps we'll be able to get a strongly bullish posture out of those other ones as well. But you know, obviously all of this is welcome news, at least to those of you that might be somewhat bullish out there after the really ugly end to the year of 2018. So it is good to see the first couple of weeks here of January heading in the right direction. I'll also note that it's good to see that we have price above moving averages in a few of the cases. Notice we do have price above the moving average with the NASDAQ and the Russell 2000. In fact, we had that Tuesday when I did the video 2 days ago. Of note is the S&P 500. As of today's close, is now above that moving average as well. Now, the moving average itself is not rising quite yet, so just be aware of that. But again, the moving average, just like so many technical indicators, is a lagging indicator. It takes past information. And so eventually, if price stays at an elevated level, that moving average will start to stabilize, start to go sideways, and then eventually go higher as well. So, it's all part of a multi-step process, and all of this is important work that's being done here from a technical perspective to stabilize these markets. So to kind of wrap it up here, we did see the S&P 500 up 0.45%. We do have the Dow Jones up 0.51%. We have the NASDAQ up 0.42% and the Russell 2000 up 0.46% with bullish postures across the board. Let's take a look now at the 3 green arrows setup, and that will be chart 4C for those of you that are premium market scholars. As we pull this up, again, we're looking at the same 4 major equity indices here in the United States with a 3-month view towards this, with each one of these candles representing 1 day in length. And you can see here that we do have some changes to report. Now, on Tuesday when I did the video, we did have 3 green arrows coming down here with the NASDAQ composite and with the Russell 2000 small caps. And that was part of the reason that we kind of did the Crocs trading idea. It was a stock that traded on the NASDAQ, which was also a small cap stock. At that time, we did not have the support of the large caps, at least from this technical analysis perspective. Today, I can say we do. Now, how long that lasts, hard to say. But what I can tell you is that officially, we did close today with 3 green arrows on the S&P 500. So it's kind of following suit of what we saw a couple days ago with the NASDAQ and the Russell 2000. The reason that we got the 3rd green arrow was we closed above the moving average. As you can see, that green arrow is now plotted there officially now that the market is closed. So we've got green arrow number 1 on the moving average. We've got green arrow number 2 on the MACD, and there's our phantom green arrow down below there on the stochastics. And the same thing can be said over here with the Dow Jones. So not only do we have bullish intermediate postures according to the market forecast indicator, but we also have stronger conditions from a trend trading perspective as well, according to the 3 green arrow analysis that we conduct here. Let's now take a look here at our intermarket analysis 12 grid, and this will be chart 4E. Now, as this pulls up, remember that when we're looking at the background colors of these kind of miniature 12 grid charts here, the green colored charts will be the ones that have a bullish posture according to the market forecast intermediate line, and the ones that have a pink background have the bearish posture. And so I guess we shouldn't be entirely surprised to see the VIX, as an example, was down 2.4% today, but it remains below that falling moving average and is at one of its lowest levels here over the last 3 months or so. Now, with the stock market being up for the 5th straight day, we should remember that the VIX generally reacts kind of inversely to the market in general as fear is kind of leaving the system. So right now, technically, you would say we have a bullish posture on the stock market and a bearish posture on the VIX. As we look at some of the other charts on this particular 12 grid here that is kind of meant to go away from the stock market, this is called the intermarket analysis 12 grid, so that way we can look at things like bonds and commodities and different things like that. So as we look at this, some of the trends that I've been kind of keeping my eye on here recently have been gold, for one. So gold was down today. Note that it was down 0.39%. But you can see that gold remains at an elevated level. And I think that's a pretty healthy sign for it. You'll see that gold was really rallying strongly at the end of last year. My perception of the situation at that time was that it was being kind of used as a fear trade. As money was leaving the stock market, it was going into where it perceived to find safety. In this case, gold was kind of viewed as that store of value. But the stock market has done a lot better since the beginning of 2019, yet gold has not given back huge chunks of those gains that it had last year. So that's, I think, a positive sign where investors in gold aren't quite convinced that there is no need for gold any longer. Some people would say, well, we'd flip the calendar. It's a completely new year. We're back to a different game script here, and stocks are going to be all the rage. Let's just load up the boat in stocks. Well, gold investors at this point still don't believe that narrative. Right now, they're holding the line. If they did believe that narrative, they probably would have sold gold off a lot harder at this point, and they just have not done that. Now, kind of assisting gold is the fact that the dollar is falling. Notice on the lower left-hand corner there, that's our US dollar chart, and that's UUP. If you want to track it at home, it's technically the US dollar versus a basket of other currencies out there. But you can see that we've really kind of fallen out of bed with the US dollar here in the last 2 or 3 weeks. Recently, we have been getting some of these oversold cluster signals, so perhaps there is a reason to believe that there might be some sort of a reversion to the mean type of a move sooner rather than later. But as of right now, we haven't seen any aggressive bounce back yet. We were up 0.6% today, but it was not an aggressive move. In fact, we still are kind of holding that diagonal downtrend right there from the short term. So right now, that, of course, helps commodities, gold, including other commodities like crude oil. Mentioned crude oil a couple of days ago, as it was the very first time on Tuesday when I mentioned it that it had closed above that 30-day moving average since going back to October. The good news is that it has continued to rally for the 2 follow-up days since that point. So it's exhibiting some good strength there, and it's exhibiting some behavior that suggests that it's trying to carve out a bottom. And it might take a while. Bottoms oftentimes aren't just V-shaped. They don't just go straight down and then go straight back up. A lot of times there's a lot of kind of tug of war that takes place between bulls and bears. But right now, a lot of that really nasty selling that we saw in crude oil last year seems to have relieved itself just a little bit. And now we are stabilizing above that moving average. All right, let's take a peek now at our next 12 grid. In this case, that will be our foreign stock markets 12 grid. This is chart 4F for those of you that are premium scholars following along at home. Now, as you can see, we've got a clean sweep here. Same thing happened on Tuesday, so not entirely surprised there as the equity markets have been behaving themselves here over the last 48 hours, but it's still noteworthy. Remember, many times in 2018, I would come to you and say, we have a clean sweep for the bears, right? We had nothing but pink charts across the board. So it's a nice change of pace to see all this green here, which suggests that at least according to the intermediate term line on the market forecast indicator, there are bullish postures across the globe. We saw a lot of times last year where the United States was doing pretty well, at least earlier in the year, and a lot of the foreign markets were struggling to keep up. Right now, you could say that the foreign markets are just as strong, if not stronger, than the U.S. markets, and that's probably a healthy sign. Now, as I've mentioned on Tuesday, some of the areas that seem to be holding up a bit better are Brazil. It continues to hold up at these elevated levels here. On an intraday basis, Brazil did hit a 3-month high here today. It is up 12.5% over the last 3 months. Not a whole lot of equity markets can make that claim out there. It's been a pretty rough 3-month patch for most equity investors. So the Brazil market, one of the more interesting positive markets out there. Not too much outdone is India. Notice that India was up about 11% over the last 3 months. Now, you will notice that its price action right now is a bit behind where it was trading on December 20th. So from that perspective, maybe not quite as strong as Brazil, but nonetheless, one of the areas of interest around the globe that is attracting investor interest, at least if you make that assumption through the price performance itself. China, of course, has been in the news a lot, and you can see China is doing just fine. For a while last year, people wanted you to believe that, well, China is losing this trade war conversation because their stock market is going lower, and that indeed was the case at that time, but times have changed. You are seeing that China is actually hanging in there just fine. Over the last 3 months, they're actually up 3%. It's more of a choppy sideways type of a chart there. So it's not like we're going to get all excited about, all of the immense gains that are going to be showered upon us. But given the context and the perspective of what's been happening with a lot of equity markets around the world, including here in the United States, having a positive performance over the last 3 months is nothing to sneeze at. So interesting development there with China. Mexico continues to perform its reversal magic. I noted that one on Tuesday as well, and it's been another couple of up days there for Mexico. So really strong bottoming process taking place there with Mexico. And then one that I didn't mention on Tuesday, but I will point out now, because it's really strengthened, especially in the last 2 days, is South Africa. Notice the last 2 days, when I did this video on Tuesday, we were down here on South Africa, which was still decent. We were above a moving average at that point, but the last 2 days have been particularly strong. In fact, today we were up 2% all by itself. Remember, that would be considered a very big up day for an entire equity index. And not only that, but price-wise, we're getting pretty close to some of those 3-month high levels there with South Africa as well. The highest level technically was back here November 7th, but we also had kind of another kind of topping out point there at the end of November. So, we'll see how we react to this level on South Africa here around $55 per share. If it fails at this level, it could be looked at in hindsight as a triple top, but if it does slice through that like a hot knife through butter, perhaps there's another leg higher for South African securities out there. And the way that you can track that on your own is EZA. All right, let's take a look now at our U.S. markets 12 grid. This will be chart 4G for those of you that are premium market scholars following along at home. Now, like the foreign markets, we've got a clean sweep here as well. The charts probably don't look quite as intriguing, at least from a long kind of trend trading perspective, but nonetheless, we do have bullish postures, and so that's a good starting point at a minimum. And as you're looking at this here, we're trying to identify where do we see strength. And I pointed out the communications on Tuesday. That continues to be the case. Notice the separation between communications and its moving average. If you look at all of the other charts on the board of all these other sectors, the only other one that comes close to that is probably discretionary. And of course, as I mentioned before, a big chunk of discretionary is retail. So with Macy's and Nordstrom's and L Brands and the like really suffering today, XLY, which is the kind of larger discretionary space. So remember, retail is just one subsegment of discretionary. But that was probably why discretionary struggled today, was its kind of exposure there to the retailing stocks. But as you look at the price action, it wasn't damaged all that bad, and it's still nicely above that moving average there as well. So those two areas kind of seem to be, the ones that are leading the most recent charge here, communications and discretionary. Other areas that seem to be doing okay, we did see that on a one-day basis, we saw the industrials that were up 1.3% today, so that was a pretty strong day for them. We saw the utilities up 1.31% today, so kind of a nice little rounded bottom taking place down there. And then real estate was also up 1.59% today. So those were your kind of bigger winners here today. And as I look at it, looks like the only one that actually was down on the day was discretionary. That was the only one where we did see some red. Let me quickly come on over here to the internet. Just to remind you guys that are watching this on our website over at marketscholars.com. Try to make it convenient for you guys to be able to give us likes and thumbs up rather than having to go to the individual social networking platforms themselves. If you do have a Twitter account, we would invite you to click like down below here. So thank you to the 92 of you that did so for me on Tuesday. I really appreciate that. Also, if you want to give us a thumbs up on Facebook, you would just click this icon right here underneath the video that you would be watching. And then on our website, you can also give us a like directly on our website as well. Remember, we've got some excellent classes coming up for those of you that are premium market scholars. Tomorrow morning at 11 a.m. Eastern Time is when David will be teaching his very popular technical analysis trading room. And then he's got a question and answer session on Saturday morning that you can attend. And then, of course, I've got my top-down trend trading class coming up on Monday. I did teach my question and answer session here today. We had a lot of excellent discussion, as we always do. So I'd invite you to check out the recording that is now posted connected to our events calendar up here if you are a premium market scholar. We had some conversation about Warren Buffett and some of the things that he likes about reported earnings and some of the things he doesn't like about earnings guidance. We kind of talked about psychology, investor psychology, about when the PL open is at a loss, right? And that can happen from time to time. We had a review of the stock Scott's Miracle-Gro. We talked about some of the new trading plans that we have here at Market Scholars that we launched here this week, or at least I did. And then we had some conversation about sector percentages and what to do if you have some drift within those sectors there, and how do you handle that within your portfolio. We talked about the bird in the hand versus the two in the bush theory when it comes to dividend yield versus a lower yield with a higher dividend growth rate. We talked about some of the long-term analysis of our stocks. We talked about master limited partnerships. We talked about how to look for stocks that might have cut their dividend, and then we also reviewed U.S. Bank. So lots of fun stuff going on there in the Q&A session. As always, make sure you're taking advantage of all of those resources. Let's now get into the trade application example here for tonight's Market Outlook video. I'm going to come back on over here to chart 4A. This will just be the market forecast 1 grid, where we look at it on a 3-month basis. And the stock that I wanted to pull up is PANW. Now, depending on how long you've been around in the investing world, you may or may not have heard of this one. It is a stock that has garnered a lot of attention over the last, let's call it 5 years or so, but it did fall out of favor. So to kind of give you a perspective, let's go back to a 1-year daily chart here briefly, and you'll notice that for a big chunk of 2018. It was one of the preeminent growth stories out there, a great trend trading vehicle right there. Lots of bullish postures along the way as we look at this chart here and see all that green in the background. Every so often getting a bearish posture here or there, but largely a series of higher highs and higher lows. That was up until it topped out right here in September 13th, and took you on a really nasty ride to the downside. Well, now that they've kind of shaken out a lot of those weak hands, perhaps they're ready for another run higher. So as I come back over here to our 3-month view, notice that this stock has done a pretty darn good job of carving out a bottom. In fact, some of you might be looking at this and saying, well, geez, doesn't this kind of look like a left shoulder over here? And doesn't this look like a right shoulder over here? And doesn't this look like a head right here? And yeah, there might be something to that. It might not be textbook, but the general shape is there for an inverted head and shoulders pattern, which is generally viewed as a reversal pattern back to the upside. And so this price action we've been seeing here out of Palo Alto Networks, again, PANW is the ticker symbol, has been quite constructive. You'll notice that we kind of had a nice little bull flag right here where we had a couple of days of pullback, but we never did breach below that moving average right there. In fact, if anything, we kind of used it as a launching pad going higher. And in this most recent thrust here over the last 5 days, remember the market's been up for the last 5 days, so has this stock. But this thing has kind of erupted above some critical resistance areas right here and right here, which would be part of that neckline of that inverted head and shoulders pattern there as well. So theoretically, where we're back to, if we want to kind of eyeball it here with our chart, we're probably back to about one of these 2 days right back here. We're at our highest levels since going back to late October in this chart. And obviously, the stock market is probably not quite to those levels quite yet. So in other words, this is a relative outperformer as it's figured out how to bottom here in the recent weeks and months. So what I thought we would do today, recognizing that indeed we do have a bullish posture on PANW, we do have a bullish posture within the technology sector, and we do have a bullish posture within the S&P 500 itself, is do a bullish trade. And the trade that I wanted to focus on is something called a bull put spread. It's a credit spread where you're using two different option strikes to create a credit to start the trade. And as long as the stock doesn't get annihilated after you get into it, you stand a pretty decent chance of making money. The downside of the trade is that you don't get incremental amounts of more and more money as the stock goes up like you would if you just bought the stock or bought the call outright. So, each strategy is going to have its own set of pros and cons. But in this particular case, the thing that we have going for us is that we don't have to be spot on perfect with our analysis. and we make money off of time decay. So if the stock just ultimately goes sideways, we will still win that trade. Let's go ahead and take a look at some of the strikes that are available. Where I'm going to go with this trade idea is actually going to be not the monthly contracts in February, but instead the weekly contracts in February that end on Friday, February 22nd. So that would be the one at this particular time that has 43 days left of life to it. So again, with the weekly contracts, be aware that you don't always have the best liquidity because they get created as time goes on, and these contracts were just created. So when we place this trade, we will place it as a limit order. We will not be placing it as a market order to ensure that we get filled at the price that we assume. And the other thing that I will mention is I did check to see when Palo Alto Networks was expected to release their earnings report, because I know for many of you that's an important consideration. They are expected to release their earnings report on February 25th from the information that I found. So that would be 3 days after the expiration of these contracts right here. So the reason I'm bringing that up is there may be a lot better liquidity as we get closer and closer there to the expected earnings release date. So what I typically do with these types of trades is come on over here to the delta and look for like a 30 delta. But in this case, the 30 delta was going to lead me to the 185 strike. And when I came back over to the chart and I asked myself, okay, do I want to be short at that 185 strike, which would be about right there on the chart? I thought to myself, I'd rather have a little bit more wiggle room to be wrong, quite frankly, because this thing, although it is turning around nicely, it does spend, sometimes weeks at a time kind of shifting either lower or a little bit sideways or what have you. So, if you're caught up at that exact wrong moment in time when your contracts are expiring, you're in a little bit of a trouble there. So I would prefer to have my sold strike below that moving average. That moving average right now appears to be kind of being used as kind of a support area for this company. And so if it were to pull back to that moving average, I'd want that to be used as kind of a shielding mechanism for my trade and bounce that price action off of it back up to the upside. So instead of doing the 185 in this particular case, I loaded up the 180. So let me show you how to do that. I'm just going to right click on the 180 put there with that weekly contract in February. And then I'm going to come over here to sell, and I'm going to come up here to vertical. That then loads up this trade idea here for us where we are selling the 180 put. So that's where we have our obligations. And in a way to think about that, if you're newer to this type of a trade idea, is that we don't want this $196 stock to go down below $180. So in other words, we have a minimum of, in this case, $16 per share of wiggle room to be wrong. And that's, the nice thing, a nice benefit of this trade is it is very forgiving from that perspective. You don't have to be spot on. You don't have to buy it at 196 and need it to go above 200 in order to make money off of this trade. If it happens, great. We would prefer that. But if it doesn't and it just goes sideways or it goes down $10 per share, you can still make money on the trade. Now, the 177.50 put that is associated with this trade as part of this spread is the strike that we're long. So in this case, +1. And what that is doing for us is it is giving us built-in protection, because we could be very well flat out wrong, right? Traders are going to be wrong regularly. So if this thing just falls apart between now and that week there in February, and this thing plunges down to, let's say, $150 per share, we are protected below 177.50 because we are the owner of a long put as part of that strategy there. Now, what I typically try to do is get a return on risk of 30% or more. So in order to calculate that, notice that I've got a credit of 59 cents that's going to start this trade. If I click the confirm and send, that gives us the numbers we need for our calculation. Our max profit, if we're just doing one simple contract, is $59. Our max loss is $191. So we just divide those two numbers into one another. So I'm going to take 59, divide it by 191, and you'll notice that that is a 30.8% return on risk there. So from that perspective, it's viewed as acceptable as well. And again, it does show you right in this case where our break even would be on this trade as well. And you can see right there, it says 179.41. So if you kind of wanted to eyeball that again on the chart to see where that is, 179.41 would be somewhere right in that vicinity. So again, the reason that I like that better than the original choice that I was sharing with you is that it's below that moving average, which can act as kind of a launching pad and a protecting shield of sorts. Not to guarantee that it will, obviously anything can happen, but at least we're giving ourselves a fighting chance with that mindset there. It also coincides nicely with where it bounced right here. Notice that it bounced right around that 179.50 area on that candle right there as well. So perhaps a horizontal support area in addition to using that diagonal support of the moving average itself. So back on over here to the trade, we'll click confirm and send. We'll review it one last time. Everything looks good, so we'll send that in and see if we can get filled first thing in the morning. All right, well, I want to thank you for being part of the discussion here this evening. It's always a pleasure to go to work for you. Markets higher for the fifth straight day, bullish postures, and so everything's all systems go for the moment. Obviously, news can come in and change that at any second, but for right now, things are looking a little bit better than they were late last year. So with that, I want to wish you a great weekend, since this will be the last time I see you. Go Rams, a big playoff weekend for NFL, and best of success with your trades and your investments. Goodbye for now.